All right, today is September 6th. Let's talk a bit about mortgage quality. Prior to the early 2000s, home buyers were typically asked to make a significant down payment of 10%, 15%, maybe 20% of the home price. And they had to document their finances, their income, their assets, and so on in great detail to persuade the bank to make them a loan, which in many cases might be 4 or 5 times their annual salary. Unfortunately, as house prices rose, many lenders began to offer mortgages to less qualified borrowers, so called non-prime mortgages. These mortgages often require little or no down payment and little or no documentation. Essentially, mortgage lenders were moving further down the credit spectrum, lending to more and more people whose credit was less than stellar. You can see this in a number of different ways. Figure 13a shows the percentage of mortgage originations, that is, new mortgages created that were non-prime, subprime, or Art A, or some other lower quality mortgage. You can see the very sharp increase, particularly in the middle of the 2000s and 2006. Almost one-third of all mortgages that were originated were non-prime. Figure 13b shows another indicator of the deterioration of mortgage quality. The percentage of non-prime loans with low or no documentation. If you think about it, this is rather perverse. If you are going to make a loan to somebody whose credit is shaky, who does not have a down payment, whose FICO score is low, and so on, one would think you would want to ask them even more questions about their income and their prospects. But in fact, it went the other way. And as you can see, by 2007, 60% of non-prime loans had little or no documentation of the creditworthiness of the borrower. So there was clearly an ongoing deterioration of mortgage quality. This situation could not go forever. Figure 14 shows the debt service ratio. As house prices went up and up and up, the share of borrowers' income being spent on their monthly mortgage payments went up. As you can see, eventually, mortgage payments became quite a large share of personal disposable income, finally reaching the point that the cost of home ownership was high enough that it began finally to dampen the demand for new houses. The debt service ratio collapsed after that, basically because interest rates came down. But the main point here is that high payments on mortgages finally meant that there were no longer no home purchasers, new home purchasers, and so the bubble burst and house prices fell. Figure 15 shows home prices. You can see the sharp increase from the late 1990s up until about 2006. But from 2006 until today, house prices have fallen more than 30%. So there has been a very sharp decline in home prices across the country. One comment about figure 15, if you look at this graph, you might say to yourself, oh my gosh, we have a long way to go, because house prices today are still significantly above where they were 15 years ago. But remember, these prices are in dollar or nominal terms. There is no adjustment for inflation, so even if there was just 2% inflation per year over a period of 15 years, that would raise prices by 13 or 40%. So if you adjust for inflation, you find that house prices now are coming much closer to where they were before the beginning of the bubble. The house price collapse had some significant consequences. One consequence is that many people who had felt rich because their home values had gone up and they had a lot of quality suddenly found themselves underwater, which means that the amount of money they owed on their mortgages was greater than the value of their homes. This is an upside down situation where the borrowers in fact has negative equity in the home. In figure 16, you can see that starting in 2007, the number of mortgages that were in negative equity grew very sharply. Currently, about 12 or 13 million mortgages mortgages out of a total of about 55 million or so in the United States. Roughly 20 to 25% of all mortgages are currently underwater. At the same time, given the fact that a lot of people borrowed more than they could afford, the decline in house prices also led to a big increase in mortgage delinquencies, people not paying on time, and ultimately the bank taking over the property, that is called a foreclosure, and then reselling the property to somebody else. Mortgage delinquencies are graphed in figure 17, and you can see that in 2009, there were more than 5 million mortgages in delinquency, which is almost 10% of all mortgages. That is a very, very high rate of delinquencies. We just looked at the effects of the house price bust on borrowers and homeowners, and those are quite serious. But there is another side to this, which is the effect on lenders. With approximately 10% of mortgages in delinquencies, banks and other holders of mortgage-related securities suffered sizable losses, and that proved to be an important trigger of the crisis. There is an interesting question here. In 1999, 2000, and 2001, we had a big increase in stock prices, including but not confined to dot-com or tech bubble prices. Those prices fell very sharply in 2000 and 2001, and a lot of paper wealth was destroyed. In fact, the amount of paper wealth destroyed by the decline in dot-com and other stock prices was not radically different from the amount of wealth destroyed by the bursting of the housing bubble. And yet the dot-com bust led only to a mild recession. The 2001 recession lasted from March to November 2001. It was only an 8-month recession. Unemployment rose, but not nearly so dramatically as in the 1980s or more recently. And so here we had a big boom and bust in stock prices, but without causing too much serious or lasting damage to the financial system or the economy. In the recent case, we had a housing boom and bust. If we were looking back at 2001, we would think that would cause a slowdown in the economy, but probably it would not be very serious. That was one of the views we were discussing in the Fed in 2006 as we saw house prices decline. Yet the decline of house prices had a much bigger impact on the financial system and the economy than the decline of stock prices did. To understand that, it is important to make a distinction between triggers and vulnerabilities. The decline in house prices and the mortgage losses were a trigger. They were a match thrown on kindling. There would not have been a conflagration. There would not have been a conflagration if there had not been a lot of dry tinder around. In this case, there were vulnerabilities in the economy and in the financial system that the housing bust, in some sense, set afire. In other words, there were weaknesses in the financial system that transformed what might otherwise have been a modest recession into a much more severe crisis. All right, that's it. I'm swollen today.